Hi, friends. Hi, learners. Professor Joe here. I hope you all are doing fine. We are starting a new series of video on Forex. What is Forex? And how can you trade Forex and make money in Forex? Since Forex is a global trading mechanism, we will start with understanding the history of Forex, and then we will gradually take it towards the trading side of Forex. So let us see the history of global trade. Thousands of years ago, traders used to travel distance and they used to sell goods in exchange of goods. This was called as barter trading. But in barter trading, there was a lot of challenges. Challenges such as carrying a lot of stuff while going and carrying a lot of stuff while coming. So it was becoming very, very challenging for the traders and the merchants to continue doing it. Eventually, the barter trading moved to paying off by using gemstones, precious stones. So then, precious stones became a medium of transaction. But as we all know, that in precious stones, there is again a lot of challenges. One stone that can look similar can have more cost, and the same stone can have a less cost depending upon its characteristics. And it was very, very difficult for the traders to find out that. So transaction using precious stone did not last too long. And then came precious metals. Yes, gold and silver. Now, gold and silver were used for a long, long period for transaction. The rulers of each country minted gold and silver coins with their face on the coin. They also used the name of their country or the name of the land on the coin. And this went on for a very, very, very long time. But eventually, the traders were finding it difficult to carry gold because at the end of the day, gold also is heavy to carry. Then started a new era, the era of promissory notes and normal notes. So in the new era, gold and silver coins were used and currency notes were used. Now, the major countries had a fixed exchange rate, and this went on till World War II. So till World War II, the major countries had a fixed exchange rate, and gold and silver was also used as a medium for transaction. But everything changed after World War II. After World War II, the US became a superpower. They called up all the countries who were with US to Bretton Woods, and there they signed an agreement. In this agreement, they all agreed that every single country's currency would be pegged to the US dollar, and US would print currencies only backed by gold. So they would only print that much US dollars for which they had gold to offer. This was the new exchange mechanism after World War II until 1971. Now, there were a lot of reasons for the announcement that was made in 1971. We will not get into those reasons because that is not our goal. But yes, in 1971, President Nixon came and made the historic speech of the suspension of the convertibility of the US dollars with gold. The new floating exchange rate was introduced. Because of the new floating exchange rate, there was a lot of volatility in the market. And because of this volatility in the market, a new era of Forex market started. What you see today is because of this particular decision that happened in 1971. The new Forex market is a free floating mechanism. Let us see some other features of this market. Now, there are three types of exchange rates. One is the free float exchange rate. The second is fixed exchange rate. And anything that falls between the free float and the fixed exchange rate is the third one, the managed exchange rate. Now, there are multiple ways of explaining this managed exchange rate. Some might call it partially pegged. Some might call it a basket of currency pegged to a particular currency. And there are different terms used. But to keep it simple, we can say managed exchange rate. So there are three major types. One is a free float, one is a fixed, and third is a managed exchange rate. Now, what are the factors that affect the foreign currency exchange rates? Now, since currency is directly associated with a country, currency is directly associated with a country, everything that is happening within a country has its impact on the exchange of that particular country's currency. There are a lot of major factors and then there are a lot of minor factors. Here I'm going to pinpoint on some of the major factors like inflation, GDP, gross domestic product, employment rate, interest rate, monetary policy, trade balance, political stability, and then, as I said, there are many other smaller factors. If a country's inflation is in control, the currency will be strong. If the GDP of a country is continuously growing up, it strengthens the currency. If the employment rate in a country keeps going up, it strengthens the currency. If the interest rates are kept low, it strengthens the currency. If the monetary policy is friendly for people to invest money into that country, then it strengthens the currency. If the trade balance, that means the exports of a country is more than the imports in the country, then the trade balance is said to be positive, which is good for the currency. Political stability, a country with good political stability strengthens the currency. So these are some of the important factors that affects the exchange rate of a currency. Now let us see who are the people who participate. That means buying and selling of these currencies. Who are the people who participate? Number one, travelers and purchasers. People who travel from one country to another country. Say example, you are staying in US and you want to travel to China. You cannot use a US dollar in China. So you have to exchange your US dollars for China. So there you have done a forex transaction. If you want to purchase something from China after traveling over there, again, you cannot use your US dollars in China. So you have to convert your currency. Now, all these transactions normally happens through a commercial bank. When you're traveling, you exchange your currency through a commercial bank. When you're purchasing, the transactions also goes through a commercial bank. So I would put this under the commercial banking transactions. Then commercial banks play another important role in currency transactions. So every single country has a lot of exporters and importers. All the exporters and importers have to convert their local currency into the foreign currency to buy and sell their goods. So all these transactions again happen through commercial banks. So they are another participants, the exporters, the importers, and again it happens through the commercial banks. The next participants are the hedging people. People who want to reduce their risk by hedging against currency. Say example, there is an importer who is purchasing goods from some another country. But the importer is fearful about the fluctuation in the currency prices. So they go into the future market and they hedge the currency so that there is no currency fluctuation risk in the deal. So there are a lot of people who do exports and imports who hedge the currency. This is also done through commercial banks. So this also become a part of the commercial banking transaction. The next important participant in Forex are the central banks. Now the central bank is basically the reserve bank of that particular country. Now how do central bank participate in Forex? In fact, they are one of the major participants because one country, when they do transaction with another country, like buying arms and ammunitions for a country, the transaction is very, very high. When a country invests money into another country, the transaction is very, very high. When a country gives aid to another country, the transaction amount is very, very high. So central bank also get involved into forex currency exchange. Now, if you put together the commercial bank and the central banks, you will see that the 50% of the participation is from the commercial banks and the central banks. The next important participant in forex currency are the investment bankers and the hedge funds. Now, the investment bankers and the hedge funds, they invest money for the rich and affluent people across the globe. Today, the globe is like a common market for everybody. People from different parts of the globe invest into different parts of the globe. Investment banks and hedge funds help this particular activity. From one part of the world to the other part of the world, they are investing money. So when they are investing from one country to another country, forex transaction takes place. These people contribute to almost 40% of the forex transactions. Last but not the least are the retail traders and the speculators. The retail traders and the speculators contribute to 5 to maximum 10% of the forex dealings that happen in the global market. So if you look at the overall participation, this is how you can break up the participation in the forex market. Why forex market is so attractive? There are some very good highlights of forex market which make it very, very, very attractive for a lot of retail traders to get into the forex market trading. So let us see what are those attractive characteristics of the forex market. Number one, the forex market is the largest market when it comes to financial instrument trading. So there are stock markets, there are debt markets, and then there is a forex market. So compared to the stock markets and compared to the debt market, the forex market is much bigger than both the other markets. The daily average turnover in a forex market is $6 trillion. Yes, you heard it right, $6 trillion. That's how large the transactions are in the forex market. The second important point of forex market is it is open 24 hours a day because it starts from Japan, Australia, going through the Middle East countries, European countries, and America. And again, it starts back in Japan and Australia. So it is continuous, 24 hours, 5 days a week, Monday to Friday. You can trade in the forex market. Yes, anytime during the day. There is no time restriction. That is one of the most important features of the forex market. There is global participation. So anytime during the day when you open the forex market, you will see the price movements happening. So if Australia is open, you will see AUD with any other currency, there will be a lot of price movement. If the European markets are open, you will see the euro or the GBP, that is the Great Britain pound, moving in comparison to other currencies. If you open while the US markets are on, you will see that the US dollar is making movements. So 24 hours, the prices are moving. It's very, very interesting. It trades in currency pairs. So here you are not buying any stock. You're not buying any bond. You're not buying any financial instrument. You are using one currency to buy another currency. Very simple. Now, forex market is a market where you get huge leverage. Now, leverage is a two-sided sword. It can be useful and it can be harmful. When we will look at the trading side of things, I will explain to you leverage in more detail. But you get very, very high leverage in the forex market, which attracts a lot of traders to the forex market. Forex market has very, very high liquidity. That's because the bankers and the brokers provide the liquidity in the market. Say, example, you want to buy a particular stock. Until and unless there are sellers of that stock, you will never be able to buy that stock. But that is not the case in the forex market. In the forex market, how much of a currency you want to buy, it is made available to you by the brokers and the liquidity providers. So the liquidity is unlimited in the forex market. And last but not the least, information available in the forex market is the same for all. You can look at the charts and you can see the price movements happening. There are some websites like Forex Factory, which provides information. And that information is also globally provided at the same time. So all the information that is provided is available for everybody, for big fund houses as well as for the retailers at one particular time. So these are some of the important features of the forex market, which makes it very, very attractive for retail traders to trade in the forex market. So the summary of this video is we had a glance on the history of global trade. We also saw the evolution of the free float market mechanism, different types of forex rates. We also saw that what are the factors that affect the forex markets. We also saw the participants of the forex market And finally, we saw the highlights which attracts retail traders to the Forex market. Now, a lot of people say that Forex trading is just like stock trading. Yes, when you look at the charts, they all look same. But there are some key characteristics of the Forex market, which you will learn only through experience. I have around 14 years of trading experience in Forex. And all my experience and my journey in the Forex market, I have written in this book called Traders You Can Win, but First Learn to Lose. I have shared my experience, how I started trading Forex, and all the mistakes that I've done, like averaging, using martingale strategy. And then when finally I realized that keeping the strategy simple is the only way to win in Forex. So I've explained the step-by-step process in this book, how you can learn Forex. And I have explained 2 strategies how to trade Forex in this book. So if you are interested in learning and understanding, you can buy this book from Amazon. If you love the content that I am creating, please like and share this video. And to get constant updates on videos related to finance, personality development, technical analysis, fundamental analysis, please subscribe to my channel. I would really love it. Thank you very much. Namaskar.